Okay, let's dig into pro picks now. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, your first pro pick is Canadian Natural Resources, the oil producer. And I've lost count of the number of people who recommend it. And they recommend it at 50, they recommend it at 40, and it's trading around $40 right now. I mean, no matter how much people love this stock, it seems to just keep melting lower. Why doesn't it get the love that everybody thinks it should get?
So, Amber, I'd concur that it is a consensus pick. We too hold this name in high regard. We've owned Canadian Natural Resources for many, many years. To your point about it being weak, I think that's really the opportunity here. So it is a blue chip name, definitely within the energy sector. It's Canada's largest oil and gas producer. It's got an exceptional track record. We've got 25 years of dividend growth coming from a cyclical industry. I think we've got exceptional stewardship with the management and the board, certainly led by Murray Edwards. They're very aligned in terms of their significant ownership as well. But it's ultimately at the mercy in the short term of prevailing oil and gas prices. So with the weakness that we've seen in crude oil, certainly made worse recently with the tariff situation, that has impacted the story, to be sure. So unlike some of the other real compounders or growth names that we talked about earlier that aren't as encyclical of industry, I think that's what would differentiate Canadian Natural Resources. The long-term charts, very strong, but you've got that cyclical component. So when we look at it here, oil in the low 60s, we do look at them as the low-cost producer. We think that they can generate cash flow down to a much lower oil price. So they're going to be a survivor. So then it just comes down to, what do we want to pay for that? Because that's the setup for the go-forward return. So, we think with that weakness that you alluded to, that's really the setup. So, we're the kind of investor that won't necessarily be following the crowds. It's one of the stocks that I wanted to profile where we've got some of this tariff-induced weakness that we think creates the opportunity. So it's been under pressure as the whole sector has, but we're more excited about energy and have been in the last few quarters than we have for quite some time. So we are being somewhat contrarian on that. We don't know the exact path of crude oil any better than anyone else, but I think longer term, you should probably be thinking about oil closer to the $70 range in terms of a mid-cycle price where it makes sense and you're going to see sufficient supply come onto the market, and that's a price where I think demand will take that too.
Okay, so I guess that underpins why you've been excited about oil recently. What is your fair value estimate for Canadian Natural Resources then? If it's trading around 40, what do you think it's truly worth?
I think that I've got a few different numbers in mind. So the first way I would think about fair value, Amber, is that I would just defer to the spot and futures market for crude oil. And I would take those prices and assume that that's the way prices play out. Why would I look at that? Well, I don't know if that's necessarily, the best forecasting tool, but it's at least a price that, producers could actually hedge at. So that would be one scenario that I would look at, and we'd probably be north of $50 a share in that scenario. I think getting back to my point about more mid-cycle prices, closer to $70 a barrel, and what kind of free cash flow yield the market would likely ascribe to Canadian natural resources in that scenario, I think you get probably closer to $60 a share. So, it certainly doesn't have the most torque. And, we own some names, and there are other energy names out there that if you're even somewhat constructive or bullish on oil prices, you could, get a better total return. But I think when you bring risk into the equation and we risk adjust this, we feel very comfortable in terms of the downside and the staying power of Canadian natural resources. And we're going to make a lot of money on this security. I don't think there's, we're very confident in that. Like even the starting yield right now is just a little bit less than 6%. That dividend's going to grow over time. The share count's going to be reduced, and it's going to be a bigger company.
I have to ask, I know it's not one of your pro picks, but if you are have a higher risk tolerance, can you name drop one of those torquier energy names you would go to?
Yeah, so I would, maybe stay in the crude oil space, or those producers with real leverage to crude oil. So I'll kind of talk my own book here, Amber. Some other names that we would own would be Cenovus Energy. So that stock's been, plagued by some issues, not the least of which their U.S. refining operations, but we think the risk reward is really good there. I would look at something like MEG Energy, which is really a focused producer in terms of in situ or oil sands. I think that's a terrific opportunity. Smaller cap yet would be something like Headwater Exploration. Great cost structure, very solid balance sheet, getting paid while you wait in terms of a very attractive dividend.
And to go back to what we talked to at the beginning of the show about election risk, if the polls hold true and it is a Liberal government, possibly a Liberal majority, does that dent the thesis at all, or have you already factored that in?
Maybe a little bit, Amber, and maybe a little bit maybe for the larger producers. Look, I think in the near term, when we think about egress for crude oil, I think that, with now that TMX is on stream, I think there's scope for expansion to TMX. That would, it's not a foregone conclusion that we would do that, but latter part of this decade into the next decade, there's some barrels that could move there, as well as on the Enbridge mainline and down through the U.S. I think that there's opportunities for expansion. So it's not that dire, but I think when we're thinking about some of these businesses, in particular the bigger players, the oil sands companies, where it's really dominated now by Canadian Natural Resources, Suncor, Imperial Oil, and Cenovus, that if you want to get into a more optimistic expansion scenario longer term, I think that really can only be done in the context of pipeline, either additions or expansions. But in the near term, not an issue. And some of these smaller companies that I referred to, they're nimble enough, and the numbers wouldn't move the needle sufficiently for them to have problems in terms of tapping markets, whether it's the U.S. or more globally.
All right. Well, people are really getting their money's worth because we just did a bunch of picks in one pick. So let's move on to the second one, which is CN Rail. I own this one as well because, everyone says it's world-class operator and all of that. And yet here it is bouncing off the lowest level since 2021. It just continues to grind lower. Yeah.
So, Amber, I've given you three stocks deliberately to be able to compare and contrast. And I think in the case of these first two names, I think highlight what we think is a pretty good opportunity where, again, it's a blue chip name. Most people are familiar with CN Rail, We've owned it here since the 1995 IPO. I think their track record speaks for themselves. I won't kind of belabor all the positives with respect to the business. We did see a stumble in 2024. I don't think it was their best year operationally. I think the setup is for a better 2025. But with the stock being as weak as it's been over the last year or so, I think that there's too much negativity in terms of, again, the operations, and then potentially what tariffs mean to this business. So, Amber, to the extent we see a more dire tariff scenario, that does have some negative consequences for CN Rail, to be sure. Although CN Rail doesn't directly pay the tariffs, to the extent tariffs cause a decline in freight volumes and in rail traffic north-south in North America, Canada, US, or even Chinese goods coming into Canada, that second order impact definitely would be negative. And, we're not sure how long lasting that would be, but it's still, it's a defensive business. The capital, the cost structure's solid. We think at these valuations, for patient investors, the reward is really solid here, just given the magnitude of the pullback and the compression in that PE multiple. So again, I wanted to give the audience a couple of examples here of where tariff negativity we think is unduly impacted stock prices, and now's the opportunity to get into some terrific, real, global quality businesses at opportune prices.
What kind of upside do you see on CN?
Well, I guess the way we would think about that is we would probably want to normalize earnings out in 2026, 2027, maybe even beyond, if there's compression due to tariffs. And then if we go back to historical multiples, 20 plus, I think that's where you easily get to 20, 30, 40% upside, maybe even shorter term in a CN Rail.
Let's end with your final pick, which is Fortis. The others are trading at lows, and you brought one to us that's trading at, is it an all-time high? It's definitely a 52-week high.
Yeah,
I think it's
Amber,
an all-time high.
Boy, you're on top of things. Yes, yesterday Fortis did reach a all-time high on an intraday basis. So Fortis is a big position for us. We have been trimming it somewhat recently. That's why I wanted to speak to this name. We went into this recent market weakness with a pretty big overweight in two defensive sectors, namely consumer staples and utilities, which is a little bit unusual for us. We have never had this kind of weight in utilities in the history of the fund. And it's not like we had a crystal ball and knew what was ultimately going to happen with these tariff policies. It's just when we look at securities on a case-by-case basis, there was a lot of good risk reward in utilities, i.e. not a lot of risk and pretty solid reward. And we've really been fortunate to have this kind of exposure to utilities because they've held up so well. Now, in the case of Fortis, again, it's an exceptional business. They've got some crown jewel regulated utilities in the U.S., both in the upper Midwest as well as Arizona. Terrific track record of dividend growth. It's held up well, and this is exactly what we would be using to source cash for opportunities like I alluded to with a Canadian Natural Resources or a CN Rail. So fading it at the margin just again because the go forward returns get less attractive as the valuation expands. So we've sold a bit, still a very big position for us, but again, these are all high quality businesses that we're speaking to. It just one's effectively at an all-time high and a couple of others have been quite weak, but all similar in the sense that they're blue chip, high quality names that you could buy for the long term and do quite well and see dividend growth. But I just think at the margin, with what we've seen with tariffs, kind of paradoxically, where I think a lot of investors would be inclined to hide because, that notion of hiding out in safe names like utilities. Well, we think that sometimes you get paid to go against the grain with a trade like that.
I love it. It's something for everybody, the buy the dippers, as well as those that want to stick with relative strength. Yeah. I appreciate it. Garey, thank you so much for joining me.